In this lecture, we are going to outline the 6 dimensions of a professional trading strategy and the difference between an amateur strategy and a professionally designed strategy. This is a necessary starting point that most retail traders get incorrectly, and therefore, they start their trading journey with the incorrect mindset about the market and how they are going to approach it. First, let's define the difference between an amateur strategy and a professional trading strategy. Roughly speaking, an amateur strategy is composed of a few tricks to get in and out of the market, and it doesn't have any sort of underlying principles that hold the strategy together in the long term. A strategy with this structure is certainly problematic, but it's not obvious why in a first moment. Since amateur traders usually lack the necessary depth of analysis about their trading ethics, they will relentlessly employ strategies with this faulty structure, and as a consequence, they will get frustrated with the results eventually. On the other hand, a professional strategy is composed of multiple minor strategies and it covers many different angles of analysis. In other words, a professional trading strategy has multiple strategies that are fully connected with one another and balance each other out. It also aims to provide a problem-solving framework instead of shallow rules to deal with inevitable problems that arise in trading. With that said, we obviously want to employ a professional trading strategy to achieve the best long-term results in our trading. This idea leads us to the recognition of the 6 dimensions of a professional trading strategy. The first dimension are the trading principles. These are the foundational aspects of a strategy that will guide the rest of the other 5 dimensions in the correct way. We will explore each trading principle individually in future lectures. For now, it is important to know the role these principles play in the 6 dimensions of a professional strategy. The next 3 dimensions are part of what is called the tripod of success. This metaphor serves the purpose of pointing out the fact that these 3 dimensions have a greater degree of connectivity between one another, and the whole strategy falls apart if any of them is neglected in some way. Just like a tripod falls to the ground if any of its legs is removed, a professional strategy falls apart if any of the dimensions of the tripod of success are corrupted in some way. These 3 dimensions are high-quality technical analysis, solid risk management, and deep trading psychology, which can also be called behavioral economics. It is interesting to notice the link between these 3 dimensions. For example, the intersection between technical analysis and risk management is what gives rise to the principle of good trade location, which is a foundational aspect of trading. In other words, it is impossible to trade using just technical analysis because the risk-taking approach becomes distorted and unrealistic. On the other hand, using risk management without technical analysis leads traders nowhere because we need to trade near the reversal points of the market, and the only tool we have for that is technical analysis. The intersection between technical analysis and trading psychology is also very important. Since high-quality technical analysis enables the trader to deal near the reversal points of the market, technical analysis plays an important role in diminishing the psychological pressure of having to risk more than what is necessary. The intersection between risk management and trading psychology is also deeply important and pragmatic. The correct application of the risk management mathematical guidelines enables the trader to operate within a relatively comfortable margin of error. This relatively comfortable state has the great quality of being sustainable for an infinite amount of time. That's the fundamental fabric of sustainable and consistent trading. The 5th dimension of a professional trading strategy is called operational logic, which is composed of certain tools that help improve the trade quality and manage particular trading situations with greater ease. The 6th and final dimension of a professional trading strategy is the trade plan, which is a compilation of rules and axioms designed to keep the trader on the right track. This last dimension has a profound importance due to the way the human brain is wired, as we are going to see in future lectures. These are the 6 dimensions of a professional trading strategy. Now we are ready to explore the first dimension in greater detail. In the next lectures, we are going to dissect each of the trading principles to truly understand their role inside a trading strategy. Contextual trading is a principle that dictates the trader must act when 2 or more trading techniques converge to the same point in the price chart. That's very important because any trading technique generates good and bad signals. When you have two or more different techniques pointing to the same area in the chart, you have a much better chance of producing a good trade. Another way of looking at this is that when two different trading techniques converge to the same point in the price chart, you are trading only the intersection between these two trading techniques. That's the best way of filtering out bad trading signals. Another attribute of contextual trading is the formation of a story for each trade. In other words, every trade must happen grounded on a few logically consistent reasons. Not just a simple setup. That's the best way to counteract the robotic and blind way of merely trading by following simple trading setups. Setups are important without a shadow of doubt, but they are incomplete if a trader doesn't take their context into consideration. The essential point is that every trade you make must tell a logical story to be justified. You cannot simply open trades because an indicator crossed over or because price has reached a support-resistance level. If it was that simple, everyone could become a professional trader in a short period of time. Let's increase the level of abstraction of our analysis and observe the contextual trading principle in its conceptual form. This picture is a good example of how contextual trading works in a metaphorical sense. When traders look at different trading signals from different techniques or theories, they are looking at true sides of the market, not at the truth of the market itself. By looking at the picture, we can see how analyzing one true side of the market can be misleading and ambiguous. If you had to guess what the tridimensional object was by just looking at one of its shadows, you could easily be misled. However, if you combine both shadows, you can arrive at a much more precise conclusion by deduction and elimination of contradictory possibilities. For example, if you were trying to guess what the tridimensional object in the room corner was just by looking at its orange shadow, your intuition would lead you to believe it was a cube. If you were to think a little deeper, you could arrive at the conclusion that it could be a cube or a cylinder, but the second option wouldn't be obvious at all. The same happens with the blue shadow, of course. However, if you combined both shadows, you would eliminate the possibility that the tridimensional object was a cube according to the orange shadow or a sphere according to the blue shadow. It's something in between. One of the tridimensional objects that fit both shadows simultaneously is a cylinder like the picture shows. The conclusion could be much more easily obtained by looking at both shadows contextually. Think of the market as a tridimensional object and the analysis techniques as the shadows. That's why we need multiple techniques working together to access the truth of the market, otherwise we're just blindly trading the shadows. By using this idea of converging techniques in context, the trader has a much greater chance of understanding what is actually going on in any given market. The reason we need contextual trading as a foundational principle is because of something called dimensional loss, which is what happens when we try to analyze a complex entity like the markets through the lens of a bidimensional price chart. The financial market is a multivariate and multidimensional complex system, and the trader only have bidimensional price charts to analyze it and extract useful information out of it. The price chart has one spatial dimension in the y-axis and one temporal dimension in the x-axis. The multidimensional market needs to be compressed and expressed in these two dimensions necessarily. That's called dimensional loss. This idea of dimensional loss is also correlated with something called Bonini's paradox, which serves the purpose to explain why single techniques don't work well by themselves. The Bonini's paradox claims that any attempt to explain a complex system like the markets become less understandable as it becomes more complete. In other words, since the market is a multivariate and multidimensional entity, any attempt to explain it fully becomes less understandable as it becomes more complete. The Bonini's paradox acts as a curse and a blessing in alignment with the dimensional loss of bidimensional price charts. At the same time that losing dimensions in the representation of price is counterproductive, it is the only viable and pragmatic option. The Bonini's paradox also points to the arrogance of thinking that one single indicator or technique is capable of fully explaining the market. In other words, by using setups or single techniques, a trader is assuming these tools have a much greater power than they actually have. However, this presumption is not at all obvious. We cannot fully explain the markets, but we can arrive at useful conclusions using the contextual trading and other principles as well. Part of this challenge is being able to recognize the human intention behind the price bars. This recognition of human intention can only be done by subjectively understanding the market, since it is formed by thousands of individuals with varying degrees of intention and power. To sum up, contextual trading is the gateway to the greater and deeper level of analysis that makes consistently profitable trading possible. In the next lecture, we are going to analyze the principle of multitimeframe analysis. Multitimeframe analysis is a trading principle that allows traders to increase their chances of finding a reliable trade opportunity by acquiring a broader and more sophisticated view of what's happening in the market. The idea that holds multitimeframe analysis in place comes from chaos theory, and it's called fractal analysis, which can be extrapolated to all chart techniques in one way or another. Chaos theory is the theory that claims that apparently random and chaotic systems are not random at all. They just function within a higher degree of order that is not obvious at first glance. From that point of view, the appropriate way of analyzing a chaotic system like the markets is by breaking it down into smaller components. This is where the idea of fractal analysis comes into play. The word fractal means pattern that repeats inside itself. If we analyze the market under this light, we can actually start to make sense of what we see on a price chart because we can break down a complex system into smaller and simpler components that later will come together again to form a context for trading decisions. It's folk wisdom that price does the same thing repeatedly in all timeframes. The only thing that changes is the degree and the time it takes for these same patterns to develop. The fact that we can access multiple timeframes in our price charts is great, because that's how we can apply the concept of fractal analysis into our trading. This application has the effect of increasing the depth of analysis to a sustainable degree. Remember that the markets are a complex entity, so it is virtually impossible to know what is going on by taking a quick look at it. This idea of the fractal breakdown of price patterns really helps to pinpoint precise moments of likely reversal in price. For now, it is important that you understand that multitimeframe analysis is the gateway to applying the fractal analysis to the markets. That's the case because by using multitimeframe analysis, we can look at the same segment of price in different degrees. Let's observe a simple and conceptual example of what that means. For example, a large price movement analyzed only under the 4-hour timeframe doesn't show too much information about the smaller components of its internal trends. If we analyze the same price movement using a lower timeframe, taking into consideration the 4-hour timeframe as a contextual starting point, we can see multiple market edges that would not be visually available just by looking at the 4-hour timeframe only. However, a trader must be careful when using this idea because we can extrapolate it to extreme degrees, and it's not really obvious when it's the correct time to stop this extrapolation. That means that multitimeframe analysis has its advantages, but it also has its disadvantages. For example, extrapolating this idea in too many fractals can lead the trader to something called analysis paralysis. Analysis paralysis is when the trader tries to make sense of too much information about the market up to the point where he freezes and doesn't know what to do. On the other side of the spectrum of analysis paralysis, we have something called objective blindness, which is what happens when the trader doesn't have enough information about the market. That usually happens when the trader tries to use simple indicators to smooth out the nuances of price data. The correct application of multitimeframe analysis is supposed to keep the trader in the middle of this spectrum, where he has just the right amount of useful information to handle his trading ideas. It can be a little hard to understand these ideas conceptually if you have never messed with them in the practical sense, so don't worry too much about that for now. It will get a lot clearer when we move on to the practical examples. In the next lecture, we are going to explore the concept of hierarchy of trading signals between different timeframes. The concept of multitimeframe analysis introduces the idea of hierarchy between trading signals among different timeframes. In other words, the technical signal in the 4-hour timeframe is stronger than this same signal in the 1-hour timeframe and all the lower timeframes below. Under this paradigm, a simple signal in the daily timeframe can sparkle a massive trend on the 5-minute, for example. That's why it is useful to pay attention to many timeframes to catch these unique opportunities. The term hierarchy implies a structure where one element is more important than another. That's exactly what it means for the trading signals generated by the many different techniques of our strategy. A good example of that is the application of support and resistance lines. If you find a meaningful support-resistance line on the 1-hour timeframe for example, this level can turn out to be incredibly important in lower timeframes. The reason for that is that larger market structures are composed of larger groups of traders ready to act in the same level. For example, if we find a meaningful support line on the daily timeframe, we can expect it to be more powerful than a support line in the 5-minute timeframe. That's the case because the magnitude of price movements in the daily timeframe is a lot greater and there are much more traders keeping an eye on it. With that said, when price reaches a level like this in the daily timeframe and we happen to be looking at a low timeframe, we can expect a dramatic reaction under the right context. To sum up, the essential point behind hierarchy of signals between timeframes is that the higher the timeframe, the stronger the signal. The lower the timeframe, the higher the level of market detail. This hierarchy of timeframes displays a trade-off between signal power and market detail. When we increase signal power, we always decrease market detail and vice versa. It's important to point out that this idea works for any technique as well. In the next lecture, we are going to explore the principle of trade location. Displaying good trade location simply means trading near the reversal points of the market. That's what every trader is after at the end of the day. Not necessarily only the major reversal points, but the minor ones as well. Trading near the reversal points of the market means you will have a small stop order and a potentially large take-profit target. This concept obviously goes hand in hand with risk management, the idea of risk-reward ratios and overall expectancy, which are paramount for the trader's survival in the long term. The best way of trading with good trade location is by using contextual trading and multi-timeframe analysis. Without good trade location, it is virtually impossible to trade consistently in the long term because the ultimate attributes of risk-reward ratios simply don't work without trade location. Let's see a conceptual example so this idea becomes a little clearer. Think of the extremes in price as market edges. As traders, we aim to trade as near as possible to these edges. That way we can guarantee that we can have a tight stop-loss order and a potentially large take-profit target. This idea of small stops and large targets is the backbone of solid risk management, and all the other more complex ideas regarding risk spiral off this notion. The other interesting thing about trade location is that it's only possible to achieve it with high-quality technical analysis like you are learning in this course. Standard technical analysis and the shallow use of technical indicators are not capable of enabling the trader to acquire good trade location. There are two reasons for that. The first is that the simple application of technical indicators usually involve a great degree of lag and the obfuscation of market nuances. The second reason is that the application of linear smoothing algorithms in price data usually produce bad results because price data is nonlinear. By simple application, I mean the application of indicators without the more sophisticated layer of fractal analysis. Indicators can be useful if they are used in the correct context and if they are layered with advanced principles like the ones you are learning here. In the next lecture, we are going to explore the principle of relative recognition of market movements. The idea of multitimeframe analysis and fractal analysis open the gate to the relative recognition of market movements, which is basically the notion that a sideways market in a large timeframe is composed of many trends on a small timeframe. This is a useful idea because it can determine how long traders will aim to stay in a trade. It also provides a broader view of the market being analyzed. The relative recognition of trends can be useful to produce trades that are highly profitable and have a good risk-reward ratio, which is what traders should be aiming for. In this strategy, you will learn the necessary tools to view the market in this broad sense and to pinpoint the precise entry and exit points of high-quality trade opportunities. Let's see a conceptual example of the relative recognition of market movements. Imagine that you have a sideways market in the 1-hour timeframe. The basic premise of the relative recognition of market movements is that a sideways market in one timeframe is composed of many trends in a lower timeframe. With that in mind, a trader can strive for trading only trending markets by choosing the correct timeframe to trade. The motivation for this can come from the fact that trending markets can be easier to trade because of the larger momentum sustaining price movement in one direction. In this example we can see that the sideways market represented in black price vectors is composed of several trends that would be easily traded on a lower timeframe. We can take this idea even further and realize that there can be sideways markets inside larger trends as well. For example, a consolidation movement within a large trend in the daily timeframe can form a clear sideways market in the 1-hour timeframe. The essence behind this idea is that no matter where we are in a price chart, we can look at it at different angles and using different perspectives. These different perspectives might help you determine the overall context of your trade. The relative recognition of market movements is a strange idea and it is a form of cognitive parallax, which can be viewed as the dissonance between theory and practice. The segregation of the market between different timeframes is an illusion. The market is an abstract entity, so when we divide it into separate timeframes, we get this weird cognitive parallax effect that happens to be quite useful for different reasons. Cognitive parallax can be better defined as the difference between the theoretical thinking axis and the experienced axis of a trader. In other words, the theoretical axis of a trader observing the market can tell him that a certain market movement is a trend or a sideways market at the same time. This perception depends on two main variables that shape the trader's interpretation, which are the magnitude of price movements and the temporal framework in which they happen. However, that's merely a theoretical construction of the trader in question. The actual experience of this trader is a lot simpler than this. The market is either going to go up or down. The interesting thing about this is that another trader might have a completely different theoretical view of the market, but he is obviously going to experience the same market independently of being right or wrong about it. For example, Trader 1 might be analyzing the market and thinking it is in a sideways mode, therefore he adjusts his analysis to conform with this type of market. Trader 2 might be thinking that this market is in a clear downtrend, therefore he adjusts his trading ideas to conform with that interpretation. Both traders can be right and make money simultaneously. That's called complementarity, which is when two apparently contradictory outcomes happen to make sense in reality. This idea explains why two traders with opposite views of the market can both end up being right about it. The complementarity effect happens because of the boundaries of cognitive parallax in the market, which are magnitude and the temporal framework of any given market movement. These two elements that surround the cognitive parallax are only possible because of the rather convenient timeframe segregation of markets. Once again, cognitive parallax is the dissonance between two different theoretical explanations of the same market. This weird effect of cognitive parallax is quite useful because it gives the trader the possibility to recognize a good trading opportunity in many ways. This ends up increasing the likelihood of success of an educated trader. By the same token, this decreases the likelihood of success for the uneducated trader because this whole idea can become quite confusing in practice. To sum up, the relative recognition of market movements is a useful tool to frame your trades using the multi-timeframe analysis of the market as a foundation. The practical effect of this idea is the increased number of available trading opportunities to the trader who understand these concepts well enough. In the next lecture, we are going to explore the principle of subjective interpretation of the markets. The subjective interpretation of markets can be seen from two different angles within any reliable trading strategy. There is the subjective interpretation of technical setups and sensitive market variables like the interpretation of price action and the power of the overall context. There is also the subjective interpretation of risk that all traders need to deal with when trading real money. We all have the same biases and we are run by the same software when it comes to dealing with economic decisions involving risk, probability, and time. However, our personalities vary greatly and the way we respond to these biases also varies significantly. Every trader is a unique individual with finely calibrated intuitions about the market and overall risk. That simply means we need to recognize these differences and work to extract the best out of them. That also means that the trader is a unique part of the trade plan, and if the trader doesn't learn how to deal with a certain level of subjectivity in the markets, no trading strategy will be able to produce good results no matter how good the strategy is. It is important to clarify why traders need some degree of subjectivity in their analysis. This happens because the financial markets, as we already pointed out in previous lectures, is a multivariate and multidimensional entity, and it is virtually impossible to roll back the chain of causality of price movements completely. That's the central point of the subjective interpretation of markets and its practical necessity. As we already saw in previous lectures, the representation of the market in bidimensional price charts has the effect of dimensional loss, and that makes impossible to roll back the chain of causality of all market movements. Consequently, part of the trader's analysis must come from a subjective interpretation of price. This is arguably the most difficult thing about trading. Since the price charts provide limited information, traders need to develop a market intuition based on price nuances. A perfect example of that is observing the relationship between the candle body and the candle tails. A trader cannot see the complete chain of causality of what happens inside every candle, but by observing the visual relationship between candle body and tails, the trader can subjectively arrive at useful conclusions about what happened inside this particular candle. Subjectivity in the conceptual sense is how an individual installs his intuitions about a given subject. This is closely related to the limited conscious bandwidth of our analytical power and the overwhelming amount of information that can be derived from the charts. The presuppositions a trader must make about the market are larger than his conscious bandwidth because the market's chain of causality cannot be fully rolled back due to the dimensional loss of price charts. This is a rather uncomfortable idea to most traders because everybody is after a completely objective and mechanical way of trading that eliminates the uncertainty out of the process. It's important to notice that it is impossible to trade in that way because of the things we are exploring in this lecture. There is no comprehensive market analysis without some degree of subjectivity. Once again, that's the case because of the complexity of the markets plus the limited tools a trader possesses to derive meaningful information out of it. It's interesting to notice that a great deal of how the market looks like in a chart is due to the subjective interpretation of millions of traders around the world. The structure of price is formed by its objective representation in a price chart, which is the nominal price you see in your screen, and its subjective interpretation, which is the perceived value of that nominal price. One of the forces that drive the markets up and down is the discrepancy between the objective price and the subjective value of any given market. For example, if most traders in the market look at the nominal price and they subjectively assume this price is higher than their perceived value of the market, price tends to fall because these traders will feel like the market is overpriced and they will open sell positions. By the same token, if most traders in the market look at the nominal price and they subjectively assume this price is lower than their perceived value of the market, price tends to rise because these traders will feel like the market is underpriced, and they will open buy positions. The bottom line is that to achieve the necessary level of complexity to produce high-quality trades, a trader must use some degree of subjectivity to read the intentions behind the price bars. As you will learn later in the course, there are several ways of doing this by looking at the way price action behaves. In the next lecture, we are going to explore the principle of interdependence between the strategy dimensions. The final trading principle that we are going to analyze is called interdependence of strategy dimensions. That basically means that all 6 dimensions of a professional trading strategy must be fully connected to one another for the strategy to work properly over time. That principle is also applied to the trading principles themselves. As it was already pointed out a few times during the course, the foundational trading principles are the base of the strategy. Every other subsequent dimension of the strategy must dwell inside the guidelines and concepts already outlined. This idea might seem overwhelming at first, but it is necessary that you study these things carefully, so they become second nature to you. One of the things you will realize about real-time trading is that the less information you have to distract you, the better it is for obvious reasons. However, the impulse to keep things simple when it comes to analyzing the market must be approached with a considerable amount of caution. In other words, as far as trading goes, things must get a little complicated before they get simple. The conclusion is that all these ideas and concepts must become second nature to you, and they serve as an automatic lens through which you begin your analysis. If you need to think too hard about them, that's because you might have not understood them well enough yet, and you should go back and review them until you feel comfortable enough to explain these things to someone else. With that said, the trading principles form the foundation out of which the rest of the 5 strategy dimensions will be born. The next 3 dimensions under the label of tripod of success have interesting intersections that are worthy to point out more expressively. Let's begin by looking at the intersection between technical analysis and risk management. These 2 dimensions are obviously related, and that's a primal intuition even for a new trader. Everybody has a primordial intuition that one should pay attention to how much one risks and how that correlates with where one is opening trades in the chart. We already went over the concept of trade location, which dwells at the heart of the intersection between technical analysis and risk management. For risk management to work in the way we will learn later in the course, having good trade location is an absolute necessity. The tool that enables a trader to reach the level of good trade location is high-quality technical analysis. By high-quality technical analysis, I mean the type of market analysis that is multi-layered and has more degrees of complexity than the standard technical analysis that most traders learn. Next, we should point out the intersection between risk management and trading psychology, which is a deal-breaker for most traders in the market. As you will learn in the trading psychology portion of the course, the human mind is full of cognitive traps that can turn trading into a rather uncomfortable activity if the trader doesn't have the correct guidance. This is especially the case if the trader doesn't use sophisticated risk management tools. The problem is that most of the psychological pitfalls encountered in trading are unavoidable, meaning that it is almost impossible to bypass them completely because they are so deeply embedded in our behavior. That's where risk management shines because it assures the trader will avoid entering the slippery slope of amplified emotions in trading. This is done by different mathematical mechanisms inherent to the way risk functions in the market. A good example is the margin of error that can be obtained by uniting good risk-reward ratios with good trade location. The intersection between technical analysis and trading psychology is somewhat similar to the intersection between risk management and trading psychology. High-quality technical analysis gives the trader a sense of peace of mind once he understands how close he can trade to the edges of the market. That's paramount because the constant feeling of doubt about entering too early or too late in a trade can severely damage the psychological aspect of trading in a moment-to-moment basis. The operational logic and the trade plan dimensions are the most pragmatic of all 6 dimensions because they put practical constraints and boundaries to what a trader can and cannot do. This is important for many different reasons. As we will see in the trading psychology portion of the course, the human brain has 2 modes of operation roughly speaking. One of them is incredibly counterproductive while trading, and it gets amplified if the trader doesn't have a pre-written plan for certain situations. The other mode is necessary to build the analysis and the pre-written plan, but it's deliberative and its weakness is its ability of acting. The bottom line is that we need both of them at different times, and we need to train ourselves to know when and how to calibrate them effectively. This lecture closes the first part of the course that explores the foundational dimension of a professional trading strategy. In the next lectures, we are going to explore the technical analysis dimension.